Global markets are climbing a wall of worry. Rising pessimism morphed into panic just before Christmas. Investor sentiment about the economy has deteriorated sharply over the past year, even faster than in 2008, and equity valuation has deflated accordingly. We're now seeing a nice bounce back in equity prices, driven by a softer Fed and hopes of a US-China deal. We see further upside, but the potential is limited. Rates markets have already erased further Fed hikes, hence the tailwind from the Fed will diminish. Let me focus on three major themes into spring: China, Brexit, and the euro area slowdown. First, China. China has been a major factor of investor pessimism. Structurally, China will continue to slow down, yet some stabilization is likely this year. Growth will stay above 6%. We have seen policy support recently, both monetary and fiscal. We find conditions less threatening than in early 2016. Monetary conditions were tighter then. Home prices were falling and capital was flying out. The credit impulse did crash again following the 2017 policy tightening, but is now finding a base. Second, Brexit. Brexit will be another key mover over the coming months. Well, the deadline may well be pushed back. Although sterling has rallied of late, option prices are still showing fears of a crash Brexit. No deal remains a tail risk, but a rather thin one in our book. There is no majority for it in Parliament, and MPs have the tool to stop no deal from being the default option. The population does not want crash Brexit either. If anything, more people now think it was a mistake to vote leave. It's true that there isn't a Parliament majority for anything right now, but we suspect that Brexiteers will eventually wobble and settle for a soft Brexit in the fear that the whole process could be undone. And if MPs cannot find a majority, they will have to go back to the people and let them vote. Finally, the euro area. Some surveys suggest investors are contemplating 0% growth, which we think is too pessimistic. It's true that incoming data continues to be poor. Looking forward, one major concern is that President Trump would turn towards Europe and impose tariffs on autos. Trump always looks for a good battle and may hit Europe, causing more disruption just ahead of the European election in May. So it makes sense to diversify portfolios, for example, toward the cheap UK domestic sectors. EM assets, including stocks, should also be favored as the US dollar is past its peak. In euro, we like quality. For instance, in credits, we think investment grade offers value versus high yield on a beta-adjusted basis. Good investments. Speak to you soon.